Welcome everyone. Week 1 investment subject here. As you can see, I'm sharing my screen. We've got the record going. So first time we've been recording on Teams. We were using Adobe Acrobat last year. So I'm hoping I'm getting all of this right. I'll test it before you get to see it. But welcome, week 1. We're starting the journey here with the subject. Obviously, you might have a few subjects going on, all of you, so that's good. So yes, this week is a very broad week, very general. Okay, it's a nice starter to the whole thing that we get quite busier. Certainly in weeks 3, 4, and 5 is a lot of important content, so we'll build into that. I will discuss obviously in our first live sessions together, face to face, in that week, everything else required for the subject. Okay, assessments, what you're required to do, where they are, getting around the Moodle, all those types of things. Okay, so we'll do that in the live session, and of course any emails or any questions you will have. But this week, as you can see, the investment environment. Okay, obviously there's 2 sets of PowerPoints here. I'll start in the record with the textbook chapter PowerPoints. As you can see, Fundamentals of Investing by Gitman and others is our textbook. Obviously these are available on the Moodle. Okay, so too is another combination of ones, and if I get some time, I'll start working through some of those. Okay, and then of course cover the rest of them in our live class sessions. Okay, so 2 lots will be there in the Moodle for you to have a look at. Now, the best thing to do, I found after doing our online learning last year, pardon me, is to have the textbook or the resource reading material, I guess, next to you as we go through. Obviously, the PowerPoint doesn't cover every word. They're leading you towards the key areas and the key parts. Look, guys, you will not get through this subject without doing the reading. Now, you don't have to memorize every word. You have to understand, and that's what our sessions are for if you don't, and we can emphasize the key points together. But it is important that you cover the chapters. We're not learning parrot fashion, but we need to get the levels of understanding to apply the knowledge. Okay, so I think you'll find the best way to do this, of course, is to have the textbook open next to you as we go through the relevant slides, and it will lead you towards the key areas. And I think that's the most effective way to do it. I know everyone does it their own way and differently. Just from experience and feedback, I think that's probably the best way, guys. Okay, so very broad base. This is pretty much like the base of the structure as we build the building. Okay, and as I said, weeks 3, 4, and 5 will be putting a lot of floors on very quickly with key topics. Okay, so let's go through our learning goals. They're not really pertinent, to be honest with you. That's the layout from the author of the chapter. So if we look at general terminology here, general definitions, as you can see, this is page 3 as we in the textbook as we go through. Okay, what's an investment? You can see that there, any asset into which funds can be placed with the expectation, because there's no guarantees of returns here, that will generate positive income or preserve or increase its value. So not only preserve its value, obviously, but increase its value in a lot of cases like shares and property, so capital gains, of course. And of course, the reward for owning it is, of course, as you can see, income and capital gains, an increase in the investment. So it's very broad. You'll see on page 3, there's some other definitions there: investment, returns, securities. What I do like about this textbook is in the paragraph indents there, they do have key definitions and key terminology. So it's always good to keep as we go through the weeks. Okay, that's always good to keep your eyes on and have a look at those as well, because they're obviously the key definitions you want to be aware of as we go through. Okay, so again, very broad, very simple to start. Like I said, types of investments as we start again on page 3 and rolls across a couple of pages in 4 and 5. Okay, so again, very simple, very broad. Okay, you can see the major heading there on the screen in front of you, and of course there's a bit more information there in the text under each one of those. So as you can see, we're talking about just the major categories here in a broad general sense. Okay, so securities or property, again, that can be intangible or tangible. You guys are all aware of what property is, but some of the other securities can well be referring to bonds, debentures, all these financial type of securities, even shares. Okay, they're not tangible. You get evidence of ownership of these things, bank bills, term deposits, all that type of stuff, investments in funds. Okay, so in a lot of that cases, it's not physical. You just get proof of your investment and ownership of those things. Okay, so intangible, tangible is the first point they can be as we define them here. Okay, direct or indirect. So of course you can invest in things directly, and this can be property or shares. They are great examples of direct investment. You either buy the shares yourself or you buy the property directly yourself. So a lot of that makes sense and that's quite logical. Or you can invest in these particular vehicles or assets, I should say, considering this is about asset allocation, and the asset classes is what we're really looking at here in week 1 and giving them their place for the rest of the subject. Okay, you can be looking at property too. Buy the property, as I mentioned, direct or indirect, can be via real estate investment trusts or managed funds that are listed to invest in property, and the same with shares. There are managed funds and ETFs and all types of vehicles, especially for shares. There's so many different types, which we'll start covering in week 3. But again, rather than doing that directly, you can do that, and this is very, very prominent, of course, with superannuation and the whole investment market now, which is approaching $3 trillion in Australia, indirectly via the fund mechanisms. Again, that's week 3, so we'll be delving into a lot of that a lot deeper. Okay. Again, we're breaking these up now, defining, so there could be debt, equity, or derivatives. So debt is all interest rate related securities. Okay, so you invest your capital, and provided whoever you've given the money to doesn't fall over, you get your capital back with some interest. So bank bills, bonds, debentures, term deposits, and there's many others. And again, we will be looking at debt later. I think it's week 9 together. Okay, we'll be looking at all those different types. And again, these definitions here are sitting in the paragraph indent there on page 4. Okay, so important to look at those as we look at these slides to marry them up and correlate them. Okay, so again, funds lent in exchange for interest income and the promised repayment of the loan. Now again, unless you've lent money to an extremely dodgy bank or credit union or something like that, you will be getting your money back with the interest. Equity, of course, is a part ownership. You can see that there. Now that is specifically what we're talking about here. Really the biggest definition, biggest fit of this definition, I should say, is shares. Of course, shares, stocks, whatever your definition wants to be, that's really exactly what fits in here. And the ordinary share, which we know so much, and we know there's so many shares out there and sectors and industries of the share market. Okay, so again, that's our equity portion or silo of the investments. And then, of course, derivatives. Now, we'll be looking at these later on down the track. They're becoming more and more prevalent. Okay, different types of derivatives have been around since the 80s, some even longer. Okay, so if we have a quick look at what we're saying here, securities that are structured to exhibit characteristics similar to those of an underlying security or asset, and that derive their value from the underlying security or asset. So, for instance, if it was futures on the ASX 200, so the ASX index, okay, as the ASX 200 moves on the physical stock market, so too would the futures for that. We're talking about futures, options, many different types of options, swaps, forwards, and we'll cover those. It's week 11 at the end, and there's alternative investments and derivative securities, and we'll be delving into all the different types of those here. But some funds, again, are using them more and more prevalently. A lot of the reasons derivatives even came into being was the fact that they were used as a risk management tool or a hedging tool. Okay, so you may have bought some stocks, you may be a little bit worried about them, you buy a put option or sell the futures to possibly negate or square off your positions. So again, we will delve more into that. It's just important you have a general understanding of what a derivative is for now, and we will again delve into more details of those later on and how they can be used if you don't understand them or have any exposure with those. Okay, so the next category and area as we break investments up. As you can see, these 6 topics are breaking investments up. And when we talk about investments, really we need to go through all of these particular categories to get down to the point or the exact factor of what we're investing in or what we want to buy. So again, we have low risk and high risk, as you can see there. You guys hopefully all know what risk is. Look, risk, I put simply, is the dirtiest 4-letter word in investments. We all want low risk, but of course we all want good returns too. And there is a massively strong correlation between risk and return. Okay, so unless something completely breaks down in the investment world, high risk, high return, low risk, low return. And they go together, and that correlation is extremely strong. Okay, and again, we'll be doing a lot of that in weeks 2 and 3 and 4 and 5. Okay, so that's possibly, or not possibly, I would suggest that is the #1 theme of this whole subject, the relationship between risk and return. And if you go off to be financial planners, that's the essence of what you will do for clients when you work out what clients' risk profiles are and, of course, their needs and objectives. Okay, so very, very important. But that's there, of course, the chance that the investment's value or return will be less than its expected value or return. It could be negative. It might be 0. It could be extremely positive. You took on a lot of risk and it'll work out your way. Just because you take on risk doesn't mean it's always negative. Risk is something to be managed and something to be aware of, especially in the investment world. So obviously, a simple example, shares are far more high risk than buying bank bills or putting money in a term deposit. Again, we'll look at those different vagaries as we get on a bit further. Okay, but again, pages 4 and 5, paragraph indent, all our key definitions are there. So please, as we look at these slides, make sure you do go through them. Okay, you can see obviously under risk on page 5, you've got speculation as well. So the purchase of high risk investment vehicles that offer highly uncertain earnings or future value. Indeed, and again, this could be shares, it could be small cap shares, it might be a lot of people used to invest in the penny dreadful shares that weren't worth very much and very cheap. But then, of course, if they were successful, especially say mining projects, they soared. They flew, and a lot of money could be made. Okay. So the next breakup category we need to look at is the actual maturity of the investment. Is it short-term or long-term? And of course, this again is another important factor. How long are you investing for or prepared to lock your money away for? Now, typically, when you read the dialogue here on page 5, you'll see short-term investments are up to 1 year. So under 1 year short-term, over 1 year is long-term. Now, long-term doesn't have an end date. Again, with shares don't have maturities. So if we're talking you're investing in shares, it might be for 20, 30, 40 years, who knows? Most government bonds in this country typically go 10 to 15 years. American treasuries still have a very favourite 30-year maturity. Okay, we do know a lot of home loans have been pushed out to 25 years now. But it's important to define short and long-term investments, because again, this comes back to our risk return paradigms. Again, what do you think might be more risky, a short-term investment or a long-term investment? And again, if you're taking on more risk to undertake one type of investment, you should be compensated with more return. And I'll come back to in a second, give you a moment to think about that. Location, domestic or foreign, that's pretty obvious. You're either investing in domestic markets here, financial markets, okay? And there's many different types of financial markets, which we will cover next week in week 2. So you can have the Australian Stock Exchange, the bond market, the currency market, all sorts of things, futures, derivatives markets, okay? Or of course, again, if you are well enabled or have, I guess, large amounts of capital and good brokers, you can access directly foreign investments, or a lot of ways for most Australians to access foreign investments, typically, again, is via the fund structure and via funds. Okay? All right, so if you didn't, we can discuss this more in week 1, but if you're not aware that long-term investments are more risky than short-term investments, we will discuss that more. But the answer to that previous little one I threw at you is long-term is riskier. because you're locking your money away for a lot longer. You should be compensated for that. Sorry, fat finger there. All right, so the next, again, page 5, as we're moving through, the next part that we're looking at here, okay, is the structure of the investment process. Again, we're just looking at some general points. Again, as I've said, the key definitions are there in the paragraph indent, and there's a fair few of those on these first few pages that are setting the scene, of course, and giving you some of the key definitions to, as we start on this road, the investment road, giving you those definitions so you can get them in and understand them, because things will build and parlay off this chapter and off these definitions, okay? All right, so as you can see, the structure, investment process, and this is the broad definition of this. There's quite a good picture I'll refer you to on the next page, diagram I should say. Bringing together suppliers of funds and demanders of funds. This is a very, very broad general definition of investment. Now, most people who have excess funds don't know the people who want the funds, so that needs to go through a system or a middleman, or in this case, the middleman per se is a marketplace, and that's the whole financial markets. So either a financial institution like banking, or in the case of shares brokers, or really more accurately, it's the financial markets, and there's different types of financial markets, as I said. Okay, the biggest one, of course, or the biggest ones, I should say, and this is here on page 5 and over into page 6 there. Okay, of course, share market, of course, we know the bond market, the currency markets, although that's not so much borrowing or lending, that's more of an exchange, extremely important for trade and economics. But we also have options and futures. Now, the short-term money market, because interest rates aren't moving as much, it's not as prevalent as it used to be, but when I was in the markets in the 80s and the 90s, of course, the bank bill and treasury note in the short-term market was very, very active and strong as well, but very static and very, very low interest rates have kind of taken a lot of the impetus and sting out of that particular market. Okay, if we have a look at those definitions down the side, domestic investments, foreign investments, the financial institutions, and the financial markets. So those two key points. The longer definition, okay, I'm not going to read them all out, guys. You all know, certainly all know how to read well enough by now. So if any of these definitions you're not sure about, you have a question about, please bring them up in our sessions, and we'll cover them off straight away to make sure you're all clear. But in regards of what we're talking about for that particular slide, now I don't know why I don't have a slide for this, but if you look at page 6 in your textbook there, and figure 1.2, okay, is a good example of what we've just discussed, and that's probably the best diagram to break it up for you. You've got your suppliers, you've got your demanders, okay, and they have to run through someone because they all physically don't know each other. I mean, if we think about this logically, right, they don't meet each other, okay? You don't have people on the street hawking to lend money for other people to borrow to get a loan. So we have to go through the intermediaries or the middlemen, okay, and in this case it's markets or the institutions. And figure 1.2 at the top of page 6 clearly delineates this for you and puts it in a nice, simple visual to work out what's going on. Your suppliers, demanders on opposite sides, they very rarely do direct transactions. So if it's a lot of investment, if it's a lot of investments, bringing them together, I should say, or taking care of people's needs is probably a better definition. Okay, you've got the money markets, which is short term. You've got the capital markets, which is long term. Now, the capital markets we'll look at next week covers both the bond market and the share market. So that's there in those financial markets. Or if it's more direct lending and investing, okay, you can see that we've got banks, credit unions, insurance companies, super funds. They're the institutions. So we have institutions and markets. Okay, so really that figure is the best visual of what we were just discussing in the previous section there and what we were doing. All right, so you can see the next part, we're still talking about this area and we're just covering some of the key participants. This is on page 6 under the diagram. Okay, now there can be other players, of course. Again, this book, it is a little outdated and older, but it's pretty much the last Australian version that's Australian centric. Most of all the other investment books I looked at last year to use, and I looked across quite a few, the latest versions of all of them are American versions with American terminology, and that's not where we wanted to go. Okay, but you see the governments are big players. Okay, they need to borrow money as well as lend money. Okay, governments' budgets go up and down. Businesses, of course, which is corporations, all types of businesses, and individuals, absolutely, which is us. But I guess what it doesn't really cover here, and what's become more prevalent in the last 20 years, and I think you'll see we've got I've got an example later on. We get down to the fund week 3, is a lot of individuals now are using the vehicles of managed funds in one way, shape, form, or another. So I'll just call them managed funds, and there's many different types of them. They are now major, if not the biggest players in the investment process and the investment markets. Okay, so super funds, insurance, well, managed funds, I should say, I'll leave it at, and mostly super funds. Okay, so they are massive players now. Okay, look, they're typically not a demander of funds, obviously, but they are a massive supplier of funds, as I alluded to just recently. I think it was 2019 figures, or late 2019 figures, 2.97 trillion, not billion, trillion in super funds invested in just Australia. So massive amounts of money. So they are massive suppliers. I bring that up for what we just looked at and talked about as an example of that. Okay, so that's a big issue there. Okay, but the individuals, I guess, I should have put on that PowerPoint via managed funds. Individuals clearly are big demanders of funds. We buy, a lot of people buy for houses, right, and cars and other things. So they're on the demand side, but managed funds are definitely on the supply side. You're there. Okay. Okay, so we start moving on. Types of investors. As we've just looked at the individual, and this is on the bottom of page 6 and page 7. I think you guys are fully aware, it's pretty obvious. Manage personal funds to achieve their financial goals. Absolutely. When they've got excess, they lend. When they need money, they borrow. Typically, individuals borrow for the big ticket items. And the investment professionals, okay, paid to manage other people's monies. So it could be individuals, businesses, governments. And again, I guess the managed funds would absolutely fit into the institutional investors area there. Okay, absolutely. Okay. And again, everyone's trying to meet their objectives of whatever it might be. Borrow, lend, invest, whatever it could be there, okay? Pardon me. We move on to the next area with the overview. Okay, so you can see this is all quite broad. They're all just setting the scene, so to speak. We're just putting things in its places, a bit like a jigsaw puzzle, where this all belongs. So as we go on from weeks 2 to 11, we know what part of the jigsaw puzzle or what part of the big picture we're dealing with. Okay, and if you're ever not quite sure where it all fits, you can always come back to week 1 and look at this bigger picture to work out what we're dealing with here. Okay. So investment vehicles starts on the bottom of page 7, of course, and goes across 8 and 9. So again, more information, more definition. I'll just, you can see the 4 major topics there, of course, and this is running across all the way across to page 11. So of course, there's more information and a good table included in those pages. So we're starting on the bottom of 7, like I said. So short-term investments we discussed up to 1 year. Okay, so if you look at that section there from 7 across, okay, it runs through a couple of examples there, and we will look at some on our other slides as well. Each of these particular breakups and asset categories, we have some typical characteristics and what you expect from them. So we do have more information on this as we go through week 1, which we'll cover. Okay, so just looking at that in between that and of course our next topic of shares, on page 8, bring to your attention table 1.1. Major types of investments, okay? So please cast your eyes across that, look at that. Unfortunately, I don't have a PowerPoint. It would be good if you had. But look, it's a very informative, it's a good table. It lays things out. It's a good summary, okay? And again, we'll be covering all of these topics as we move on. So you can see their short term, okay, you've got a description, then you've got examples. So this is a good reference table, guys, okay? Ordinary shares. Okay, we know what they are. Equity investments, fixed income securities, we've got some examples. Bonds, convertible securities, preference shares, there can be debentures, there can be other things. And bonds can be all types of things, corporate bonds, government bonds, etc., okay? Managed funds, which we just spoke about. Again, when we say managed funds, it covers all of the different types of funds. Derivatives, which we've already spoke about, deriving their value from another physical asset or underlying security. And miscellaneous, that's with real estate, as you can see there, tangibles. We could be talking about gold, talking about commodities. Okay, so there's many different things that fits in that miscellaneous. We cover that. That's week 11 and into week 12 with what we call alternative investments. Okay, so we will be looking at those as well. All right. As you can see the examples there, which is good. Okay, obviously short term, you've got deposit accounts, certificates of deposit, commercial paper, which is bankers acceptors, which is bank bills, very short money market type of funds. So that's good. It's a good table. Please be aware of that and cast your eyes across it if you're not already familiar, okay, with those types of vehicles. Okay, so you can see the next few pages goes through those with the descriptions. Okay, obviously we talk about liquidity. Okay, that's in the paragraph there on 8. Okay, then we get into ordinary shares, of course, and what dividends and capital gains are. So again, we will be covering more about ordinary shares in more detail in week 8. If you're not quite familiar about some of those, please read that now. I'm happy to answer any questions on that, okay, in our sessions. But I'm guessing you've at least heard what dividends are and you're aware of what capital gains are. As we go across to 9, we have our fixed income securities, okay. So investment vehicles that, again, fixed income will be 1 year or more because they are long term. Okay, and we'll cover this a bit later, that anything under 1 year is done on a discount basis. Okay, I'll explain that later. And longer term fixed interest securities are done with coupons or regularly 6 monthly or yearly interest payments. Okay, because bonds are typically 3, 5, 10 year, 15 years. Okay, so you are locking your money away for a while. So it is like an IOU. It's paper. It's like an IOU from whoever sold you the bond has borrowed the money. In a lot of cases, the government bond market is the biggest in this country. So it's the government borrowing the money off you. And we'll have a look when we get to week 9. It matters what their credit rating is. Okay, and luckily at the moment, our government AAA. Okay, although COVID's certainly changed a few things around the world at the moment. Okay. You can see there on page 9 the different types. Okay, you don't need to know the ins and outs of all of them now. We're categorising things and putting things in their place. Okay, so you can see that information there. Have a look at that. Bonds, convertible security, preference shares. Okay, worthy of that read. Managed funds, of course, right? So again, just a broad definition. An institution that raises money from the fund investors and invests in and professionally manages a diversified portfolio of securities. Now, it can be shares, anything, bonds, whatever, or real estate. Okay. So again, it's a pooling of the money, as you can see, pooled investment. They get investment from many, many different people, aggregate it, and then invest those bigger amounts. Okay, so managed funds, of course, runs across 9 and across 10. There's different types of funds now. Okay, so you can see that there with on page 10 with hedge funds. Okay, and we will be covering hedge funds. There's some videos there in week 11. Okay, at the moment we've got the hedge funds. They're definitely a managed fund. They're a very different type though. At the moment we've just got them pigeonholed into the alternative investments. But we will do a bit of talking and there will be some discussion in week 3. Also, the managed funds topic on hedge funds. So if you have a quick look on page 10, if you're not quite familiar, if you've never seen the show Billions on, which is very, very good on hedge funds. Okay, managed funds that operate in a variety of markets using a variety of investment strategies, which are generally riskier in nature in order to secure higher returns. So they're high performance funds. Typically it's a big investment, a big buy-in. They take a lot more risk. They use derivatives, they use leverage, they use borrowed money to invest. So yeah, it's not typically your regular investment. It's not typically for your mums and dads or normal consumers. Okay, but we will look more into the details of that as we go along, guys. All right. Moving a bit further down, derivatives. As we've said, we've already talked about what in general they are, deriving their values, okay, from the assets of the underlying security that they're created from. Okay, options and futures, of course, are the two most popular. You've also got forwards, you've got interest rate swaps, especially in the bond and long-term market. And again, we will cover all of those different types as it comes along. Okay, but again, page 10 there, you can see that. A couple of definitions of options and futures. If you're not fully au fait with them, okay, now I can explain a bit more, but again, we go into more detail later on in the subject about those and what they're about. If you want to have a quick look ahead, go to week 11 and there's videos there, big definitions, a lot more detail and specifics about exactly what they are if you're interested and you want to kind of jump ahead. Okay, and again, other popular investments, like it says, real estate. But look, property is one of the major asset categories, so I wouldn't really go in, others, miscellaneous. Property is not miscellaneous. A lot of funds invest in real estate. There's a lot of real estate investment trusts. So I would be classing property as a different asset class. But more here, looking at things like commodities, as I've added to this slide, gold. You've even got infrastructure investments, private equity, hedge funds really, even though it's a type of fund, it's not as prevalent in this country as America. So yeah, you can put all of those. And again, week 11, if you want to jump ahead to have a look at some of the different types there. Okay, then he goes to a kind of a step-by-step process. You can have a look at this. This starts on the bottom of page 11 and runs across the next page and page 12. So really, again, we don't have to take this in by heart. It's a guideline. So just, pardon me, cast your eyes across it and have a quick read. Okay. It's not particularly, we don't emphasise it in the assessments and delve into it too much. But it's really just setting a framework, setting the guidelines of what steps would you look at to invest in. So again, I'll leave that there for you guys to have a look at, page 11 and 12, meeting your investment prerequisites, as you can see, life, risk protection, returns and wealth. Absolutely, typically why you would do it. Establishing investment goals, which will determine your types of investments. Absolutely. What are we investing for? Is it for retirement? Is it to save money for something special? Is it for putting money away for, when my kids go to college and graduate, or getting them into university and college, etc.? Again, we have to stipulate what those goals are. Are they short-term, long-term? What exactly for? Because then when we know what the goals and objectives are of investing of the clients, then we can start to match up the relevant products and the other relevant characteristics. So is it retirement, income, major expenditure? Are you trying to shelter from tax, or reduce your tax, etc., etc.? So again, there's different, those 4 points are covered there on the top of page 12 where they talk a little bit more about it. So again, just cast your eyes across, have a quick read of it. Adopting an investment plan, as you can see, so written document, how you're going to invest, target dates for achievement of investment goals and objectives, amounts or levels of tolerable risk. So we're setting this out. Again, the risk and return paradigm comes in, as you can see here. And again, there's no guarantees in investing. Okay, we can look at past performance. We can look at what we typically expect when we look forward, and we'll cover this in week 4. As we look forward, we are looking at expected returns, not factual returns, expected returns. So as we invest and go forward, we expect these returns. We expect certain levels of risk or volatility. Not many people saw the GFC coming 12 years ago, and not too many people really saw COVID coming last year. So they are massive events, I admit, but these things can come out of the blue. And if you'd have told me 10 years ago we'd have near zero interest rates, I would have called you insane. So look at where we're sitting now. So you can never say never about certain things in the financial markets or investment world. And we've got to be able to adapt and overcome to whatever circumstances we're actually dealing with. So as you can see in this particular case, I'll just give some examples of that. So all you can do is invest on reasonable and what you believe the markets will do for 80 or 90% of the time. Okay, within 2 standard deviations, and if something very rare happens, it's out there. You just got to deal with it and roll with the punches. Okay. Obviously 4, you can see that, and I've talked about that a couple of times. Okay, you're evaluating your investment vehicles, absolutely, on the basis of potential return and risk. You can't talk about one without talking about the other guys, and we'll do a lot more of this in weeks 3 and 4. But when you discuss one, you discuss the other. Really, really important. Risk and return go together, same sentence. Okay, oh, I got 10% return. Well, how much risk did you take on to get that? Really important, guys, in this subject and investing, okay? We must put them together in the same sentence and the same definitions. Okay, so selecting suitable investments, we're getting down now through the steps to actually picking what we're going to invest in. Okay, it has to be consistent with the client or the investor's goals and objectives, their risk return preferences. Okay, of course, then we start selecting what investments they might be. Then we construct hopefully a diversified portfolio. And we'll be doing a lot on diversification in week 5. Okay, very, very massive topic of week 5. Okay, and again, we want to maximize our returns, or as you can see, risk-adjusted returns. And we'll look and see how diversification works there. And then, of course, managing the portfolio. So once it's been created and put in place and the investments are made, we need to keep managing it or keep reviewing it in an ongoing basis, of course, which, again, seems quite logical, right? You can't just set and forget for 10 years unless everything goes perfectly and all the markets go into a 10-year bull run and you can just go off on a holiday and look at them some other time. That's not reality, right? That's just dreams. So we have to typically a yearly basis, we review and manage your portfolio. Okay. Tax planning, of course, comes into it. Page 13 there, as you can see. Look, we touch on tax as we go through this, and of course it's an important consideration because really, essentially, we want to look at our cash flows or our investment returns after tax. Tax is a reality. It's a fact. We don't dwell on it here. This is not a tax subject. We just need to be aware of it in certain areas, certainly with dividends and in week 8, shares and things like that. So we'll cover those as it comes along, but it is not a major part. We just need to be aware of the generalisation that tax is real, different taxation on different things, okay? And when we talk about our returns and our outcomes, we're talking about after tax. Okay, so again, you can see that there. That's page 13, investments and taxes here as well. Tax planning, of course, is so very important and a big part, of course, of the financial planner's work and life and dealing with clients, of course. Okay, so I'm not belittling it. I'm just saying we're focusing more on the investment side and what makes up the investment side of things. But tax is a big part of that. Okay, obviously, this is just general now. It's quite logical. We can talk a little bit more about this in week 1. But if you just have a look at what's in front of you there, and it's on the bottom of page 13 and goes across to page 14, a lot of this makes sense, doesn't it? Investors have different risk-reward profiles or risk-return profiles as they go through different parts of their life. Absolutely, and especially if we're really talking about superannuation and things like that. And not everybody adheres perfectly to this, but in general, this covers the vast majority. Okay, typically when you're young, and again, often people when they're young, I'll admit I fit into the same thing. I just thought when I first started with super, oh yeah, balance seems right, you know, and it'll just build up and compound and all that stuff. But think about this logically. You know, the markets have bull runs and they might have unless we have a massive recession or depression or something, and they'll have a 2 or 3 year correction and then they start again, etc., etc. So, and property's done a lot of the same things that the shares have. There's a lot of mirror image in both the asset classes, okay? And I call them the growth asset classes, I should say. Let me define that. We'll do more on that. Growth asset classes. Because you get capital gains out of property and shares, you don't get that out of interest rates and some of those other investments. So essentially, we should be very growth orientated. We might take a couple of bumps in the early years. There might be a couple of years with losses. But when you're young, you have many years to make them back. And again, I guess if you've had a correction, then you're buying in at lower levels, aren't you? I know this sounds corny, but it's a fact. If the market's correct and you're still investing, if they do tend to go back up again, well, then you've actually bought or invested in the market at lower levels. Middle age, you've got a consolidation. So they're saying very growth orientated 20 to 45. You'll be talking 80% growth type outlook. Middle age consolidation, you might be coming back to a more balanced. So again, that might be 60-40 growth, 45 to 65. So if things have gone well and you've made the money in the 20 to 45 years, Look, you still need to accumulate more money, but you want to try and keep most of what you've got, of course, again, unless we have a GFC or a COVID. And again, the effects of compounding over all those years have really paid dividends or had their effect for you. And then, of course, as we get to 60 and above, income-orientated retirement years, you pretty much don't want to lose any capital. You just want to build on it and keep everything you've got to keep it in place. And again, this is all logical. It all makes sense. Have a look at that there on 13 and 14. What I will throw at you and address more, I guess, in week 1 as we talk, the income-orientated retirement years, yep. Literally from GFC onwards for the last 10, 11 years, that paradigm, that thought process has been thrown out the window because interest rates have just kept coming down. Globally, they've been zero for longer than here, but in the last year or two, they've got to where they've got to in Australia. So it's created what I consider to be the great issue in investments and in financial planning now, because most balanced funds or both balanced risk profile outlooks would include, 25, 30% fixed interest, and going back to the 80s and 90s, you could just set and forget, get 5, 6, maybe more, 7, 8% in safe government bonds. That option's gone. But we've still got to earn income for people. So where does that come from? We'll talk more about that in week 1, but that is a massive challenge. It is the biggest challenge in the investment world, apart from panics and catastrophes, just in a normal run of the markets. That right now, and the historically low global interest rates, is the biggest issue in the investment world. The business cycle, of course, this is tying it in with economics, okay, and being aware that our markets do move in cycles. We call them business cycles, but it's got to do with economic growth, which of course drives business conditions, booms and contractions, okay. We'll be covering a lot more of that in week 7. For all of you guys who've done economics before, it's nothing new, it's nothing brilliant. It's just tying in the investment cycles and their performances, of course, with the economic cycles and economic conditions. Now, again, think about this. Companies operate for shares, companies operate in the economy. They make their money dealing in the economy. If they do well, their share price goes up, etc., okay? I'm summarising, but there's a direct and obvious link and correlation here. Okay, of course, if the economy is booming or long interest rates go up, if it's weak and we've had problems like now, then of course interest rates are very low to try and stimulate the economy. So again, just some of those paradigms. We'll do a lot more of that in week 7. Okay. So then we get to the bottom of 15 here. I beg your pardon, top of 16. I apologise. Page 16, and he's emphasising a bit more the short term here. And the other slides I have, which I'll briefly touch on at the end, but really look to cover in week 1 in our live session. Okay, goes through more of the asset classes and what they typically are. So I'll show you briefly at the end of this. Hopefully you'll get a chance to look at them before our session, and then I will cover them in more detail. Okay, so here in chapter 1, I think you saw the layout earlier, he emphasises here the role of our short term. Remember, short term under 1 year. Now again, page 16, okay, going across to page 17, okay, is more detail, more specifics here on this. So the primary function, of course, a pool of reserves that can be used for emergencies. So again, typically short term, we're not keeping them out there too long. Obviously, we're investing, we want a return on our money, but it might be 3 months, 6 months, 9 months, whatever. We're highly liquid investments, so something that we can easily cash in or sell and get our capital back without any great loss of capital, or what we say in the industry of taking a haircut. Oh, hang on, I need my money now. Oh, hang on, well, your price is down here now if you need to get out. It's not an emergency fire sale. In a good liquid market, you'll get a market price, and that's what good deep markets are about, which we're going to cover in week 2. Okay, liquid markets provide heaps of buying, heaps of selling at market prices. And again, this economic instability, like we've recently just had last year, GFC, a lot of money tends to come out of the longer end of the market, which is riskier, and into the shorter end of the market. Okay, so this is where your bank bills are, your promissory notes, okay, treasury notes by the government, term deposit, cash management accounts, all those types of facilities that are typically up to 1 year. So we're looking at emergencies, we're looking at balancing cash flows, we're looking at liquidity, and also we're looking at maybe what risks are happening. But again, I started in the markets in the mid-'80s, and I've lived through the interest rate up and down roller coaster where I've seen, 16.5% cash rate, 18% bond rates, all the way down to where we are now. So again, the short-term investments were clearly more prevalent and very, very popular in the mid-'80s all the way through the 90s when there were higher interest rates. So again, I'm just throwing it out there in today's current climate and interest rate settings, not so popular here anymore. So people have been looking outside the square at other alternatives. You guys have probably seen where gold has gone the last 10 years since the GFC. It's been on a boom. So people are looking outside the square because the typical safe investments are not providing them returns. It's a big issue. Interest on short-term investments, I mentioned this earlier. Okay, now this is there on page 16, and I'll do more on this in the first week, an example for the ones who may not have come across it before. You can get a stated rate of interest, like from your term deposit, your savings account, a cash management account, whatever it might be. You'll get 3%, 2%, 5%, whatever it might be. Okay, now that's typically your banking products, okay? Obvious banking products for consumers, individuals. But in the financial markets, in the money marketplace, now money markets are 1 year and under, the securities trade on a discount basis. Now, guys, if you look up the meaning of the word discount, it means you'll buy it for less than what it's worth on its maturity or when it finishes, when the investment ends. So in other words, bank bills, treasury notes, commercial bills, promissory notes, any of those, and we'll cover more of those a bit later, that fit into this definition, they're always going to be worth face value, which is what we say is 100. We quote them out of a price of 100. They're always worth their full face value, whether it's 1 million, 10 million, 100 million. They're worth that on maturity. But when you buy them at an amount less than 100 or less than the face value of 1 million. I'll give you an example. So say you had a 6-month bank bill, you might buy it for 990,000. In 6 months, you'll get $1 million back. The difference between what you pay and what you get back on maturity is the interest. So you get the interest. You don't invest the full amount, 1 million. You invest 990. You will get $1 million back. The difference between the two is the interest you have earned. That is a discount security, and I can run through more examples there for you. Okay, guys, but typically, and again, that's on page 16. Okay, a method of earning interest on a security by purchasing it at a price below the redemption value or maturity value. Okay, the difference is the interest earned, like I just said. So again, I can use some examples in week 1. It's important to know under 1 year short-term investments operate in the markets that way. Obviously, out past 1 year, you get either semi-annual or annual coupons, and that's your interest. Okay, so what's the risk? And this is on page 16 as well. Typically, they are low in risk. That's exactly right. Because, again, they're shorter term. So short-term risk there. Typically, again, unless a bank goes bust or you buy bank bills, they're guaranteed by a bank. Promissory notes and commercial bills are corporations. Treasury notes is the government. You buy government or bank bills, you will get your money back. The government won't say it, but they typically guarantee our top 4 banks. So you will get your money back. So the risk there of default is minimal. And again, liquidity-wise, you can always sell them in the market to get your money back if you needed it for emergency funds. Okay, so that is there. Okay, it's there and available. So they are low in risk. And again, you're not committing your money for great amounts of time. A primary risk is inflation risk. Yes. I'll give you an example of that in a second. I just spoke about default risk and exposure to capital loss is very, very, very low. And even if you bought a commercial bill and you think a company might be going under, if all you've done is bought a 3-month or 6-month commercial bill, well, what you know right now, most corporations don't just go bust within the next 3 months. If they are in financial trouble, you'd know about it when you invest the money. So keeping things short term doesn't allow those long-term issues to materialise. Okay, so that's that there. So default risk is It's never zero, but it's very, very low. Capital loss should also be low. You're not trading, you're not an institutional trader, you're not trading bank bills, you're investing and then getting your money back. Now, inflation risk, definitely. Now, this is a situation like we have right now in the markets right now with historically low interest rates, and technically our inflation rate, the rate of CPI, if you look it up on the ABS website, Australian Bureau of Statistics website, is actually above our interest rates. So clearly our central bank, the RBA, is trying to stimulate things massively. We understand that. We know that. Okay. But if all you're getting on term deposit is 0.5 or 0.75 or 0.9, and the rate of inflation is 1.7 or 1.75, okay, inflation erodes the purchasing power of money. It erodes the value of money. Now, in normal times and 90% of the time, interest rates are above inflation. But if you park the money in the bank, you get a reward above inflation to get what we call a real return, okay, a return above inflation. Otherwise, who would put their money in the banks? No one would. Banks wouldn't have money, wouldn't have it to lend. I mean, that's the oil and the petrol that runs the economy. So it would cease to a halt. And if you look at what made the Great Depression in the 1930s so bad was a credit crunch, and banks stopped lending to each other. So, but I come back, and we have got inflation risk right now. You put your money in the bank in a 6-month term deposit and say you even get 1%, which would be a miracle, okay, because the cash rate's 0.25. Inflation's 1.75. Now it's safe, and you're protecting your capital. I get that, because you may not want to be involved in the share market and that, and especially obviously last March when it crashed big time. Okay, obviously we're getting past that and getting better with COVID. But my point is, with the historical, and this is, I can't think of another time when interest rates have been like this and inflation, because even in a recession or depression, inflation would be near zero. Okay, so we don't have rampant inflation. Inflation is not a problem, but it's still higher than our short-term interest rates. Obviously, the government, the RBA is trying to stimulate on behalf of the government and get people to borrow money and invest that money, certainly in capital projects. Okay, now that's, again, more economics. Okay, we won't get too carried away there. That's week 7. But I guess the other risk here on short-term investments, which, again, this is written in 2011-12 or something, this textbook, interest rates, and I think you'll find the cash rate then was maybe 3.75 or 4%. I can look that up for you. I have a chart. Not 0.25, and in other countries of the world, 0. And not just 0, central banks have been quantitatively easing and printing money. So interest rates are just almost negligible. So the short-term end of the interest rate spectrum and short-term investments has been hit for a massive crock, a massive 6. Okay, literally gone over the cliff in the last 5 years or more. So even going back, before this last, batch of emergency rate cuts, let's go back 3 years, 3.5 years in Australia, our cash rate was still like 2.25%, 2.5%, 3-4 years ago. So that was still above inflation. You were still getting a return, not 0.5%. So that's been the big issue right now on the short-term investments. And I would add to that particular slide, historically low returns that don't cover inflation is how I would look at that with the risk of short-term investments. And again, that's only for now and maybe for the next 2 years. Advantages, disadvantages, if we go across, beg your pardon, let's go across, that's at the bottom of page 16, sorry, across to 17, my apologies. So again, high liquidity, they're a low default risk. Yes, that's why we do it. And again, if they're low default risk and they're low risk, we typically get lower returns anyway, even in normal times. You get lower returns on bank bills and short-term investments than you would on bonds and longer-term investments. Again, the risk-return, risk-reward paradigm. Okay, they're relatively low return, as I've said, and they're sensitive to interest rate changes, absolutely, because the short-term market absolutely moves with, the setting of interest rates. I'm not going to go fully into economics, but again, week 7, we do cover macroeconomics. Again, if you're not sure, ask questions, or we'll cover it in week 7. But obviously, the central bank in Australia moves rates. They've moved rates to extremely low settings, as we just spoke about. So that's clearly had a big effect on that short-term market. Okay, investment suitability is on page 17 there, and it goes, some of these headings go across the next couple of pages. Again, just take it in a general form, pages 18, 19, okay, which pretty much finish the chapter. Just very broad. Have a quick read there to take in, the points in summary, so to speak. Okay, so investors most of the time will hold part of their portfolio short term. As says part, now this could be 5%, could be 10%. Other times it might be, if it's, the stock market's in a bear run or crashing, it might be, 30, 40%. They'll adjust their weightings depending on conditions and, of course, their goals and objectives, as we looked at and saw earlier. Okay, so there will be times, depending on the weighting and how much, they're in short-term, highly liquid securities. Why? Safety and security, yep. Act on unanticipated investment opportunities, so it could be strategic or tactical. I'll come back. Unfamiliarity with other investment vehicles, that could be a big case. A lot of people don't know, okay, they know what shares are, but they don't know about the sectors and the industries. They don't know about a lot of what the managed funds do now, and there's so many different types now. They mightn't be aware how they can get into gold or property. So just a lack of knowledge of their other opportunities and choices. A temporary outlet to park funds is definitely a valid one. Now let me get back to that number 2. This is where a lot of money, especially from the professionals, especially from the funds and things like that, if all of a sudden they view the growth markets, so property and shares are looking at a bit of a bearish run, or the next 1 or 2 years is looking to be a bit of a negative outcome for them, they will cut back their weightings or cut back their investments in the longer term market, in the growth aspects of the market, property shares, okay, and they'll park those funds and they'll just look for a return, but park them somewhere safe, look for a minimal return, because they'll figure that even earning 1 or 2% is better than losing money and losing capital. So in a lot of cases, they park them there to wait for the market cycles, to wait for the market to turn, to wait for it to turn around. So in that particular case, and the people who utilize that, it could be a strategic or tactical decision. Absolutely. They're just parking the funds, waiting for the next opportunity to invest, to buy, to attack. And that's a very, very valid thing. So that's another issue there with that as well, depending on the circumstances, of course. Okay, look, the rest of the chapter, as you can see here, and he goes through on pages 17, 18, 19, different careers in finance. You can have a quick read of that if you like. He talks about different things there. That's not pertinent to us, and it's not relevant really to what we're covering. Okay, so you can see that. That finishes off our chapter 1. Okay, PowerPoints. Now, look, I'm not going to go through them all. I've done a fair bit already. I'm just going over to the other PowerPoints. Now, these were 2 different sources. I've combined them. You'll see most weeks. You will see as you go through the weeks, there's a combined PowerPoint one. So this is where we've had material and resources from various sectors, okay? And you'll see the readings there. So, but in a lot of the readings, you're not reading every page. You're just reading 10 pages here, 15 pages there, because they're good and pertinent without, the whole thing. And it just enhances and adds value to the textbook we have. So again, I'll guide you week per week. Don't think, oh God, I'm reading all of this every week, and that you are not. Okay, we'll guide you towards the key points. So from that point of view, every week there's textbook chapter, and then also typically, okay, some combined PowerPoints. So for this week, what I'm going to look to do, okay, I'm going to start off our live session. Hopefully everyone's seen these PowerPoints I've covered in my pre-record. I can come back to them at the end, but I'll be starting by looking through these, and you'll see what we have here, investment choices. So we're getting into the asset classes a little bit more specifically here. So just to give you a quick look, again, we have introduction, risk return is important, okay? You guys, if you get a chance, have a look at this before our session on Thursday, okay? Typically we have risk averse. We're assuming 3 things about investors: that they're rational, they're risk averse, and of course they have an unlimited demand for wealth. Absolutely. Again, that's logical. It all makes sense. Okay. Again, some of the general attributes. These in regards to the other readings, I'll point you towards them. They are all there on the Moodle. What the nature of his investment is, allocating wealth into various assets. that are expected to yield future returns. So again, a slightly different definition, but on the same path, on the same track, meaning the same thing. Okay, and again, in a different way of looking at this, okay, investors, do they need money now or in the future? So borrow or save and invest. If current consumption exceeds your wealth, you're borrowing. Typically people do for houses, right? There's an example. And when wealth exceeds current consumption, typically as you get later on, you start investing or putting more money into super, etc., etc. Okay. Second choice is between what investment assets, and these slides talk more about the particular asset classes, which again fits into our broad definition of the investment environment of week 1, which is what we're doing. Okay, so again, in assets differ in terms of risk and return. There's that risk and return again, right? That's such an important paradigm. Okay, return arises, time value of money, rate of inflation, the uncertainty of future cash flows. Okay, they're the risks that relate to the returns. And of course, again, I've emphasised this, the greater the risk of the investment, the greater the return, they're correlated, they go together. So again, I know it's a repeat, but it's really important to remember. Okay, then it talks about a 3-step process. Okay, I'll leave it here in regards of detail. I'm going to start picking some of this up in our live session in week 1, but you'll see we cover that. There's a nice diagram there from other resource reading material. So essentially in week 1, we're dealing with the allocation decision, investment identification, investor preferences, and the management. Performance evaluations week 4, and then we look at that review later. So I'm just showing you through ahead what some of these slides are. Financial markets, of course, derivatives we've covered, international as overseas. Then we spend some more time looking at the typically, now there are some other asset classes now, and as you know, we've got others or alternative investments, which we're clearly covering and should be added to this. Okay, cash, fixed interest, property, shares and equity. And again, there's very many different choices, especially in shares and property and fixed interest, many different choices when we break these very big and broad asset categories down. Okay, so again, these slides just generally and summarily go into some more details of each one. Okay, and we've looked at some of this. How are we, the investment assets, how are they classified? Okay, you can see some of those equity, international equity, cash-like, that's short-term money market, fixed interest is long-term, property, you can see that there, and alternative or other investments. So really, we have 6 key categories now, and you can see those examples there. And again, there's some examples of what particular products might be, investment examples in those asset classes, okay? An example of some returns of those, I'll discuss that as we have a look at 1996 to 09, so it's a bit old. You can see that crash there is kind of the start of the GFC, so certainly it's a bit old, but it's a good reference guide. And then you can see investor preferences, again about risk, short-term, long-term, which we've briefly covered. So there's a bit of a recover over. We'll talk about passive and active, although that's a lot more relevant to managed funds in week 3, but we'll have a quick look at what that's about. And then we're getting into the broad categories and what their attributes are. So I just wanted to give you a quick summary, a show. Hopefully you'll get a chance to have a look through and check it out before we're together. But that's what we're going to be looking at covering as we get together. The characteristics, as you can see, and the key points, factors about each broad asset class. So cash, fixed interest, here's property. Some of the examples of how you can invest in them. Property, again. Okay, shares, and you all know what shares are, but again, the diversity and the choices in shares is immense, both domestically and internationally. Okay, shares, again, we're talking about other things. Returns, capital growth and dividends, of course, fair bit on shares, as you can see. Okay, and then we get into risk-return relationship. Okay, so I'll leave it there, guys. I'll give you a bit of a preview of what we're going to be covering in the first hour and a half of session 1, as well as taking you through what your assessments are, how to go about them, the Moodle, and of course any of your questions that you most likely will have. And please bring them along to week 1. Okay, I'll look forward to seeing you guys all there. week 1, and we'll get into it, and yeah, we'll have a bit of fun hopefully. And I know study always seems like a chore, but hopefully this one won't be. There's some very, very interesting things, and it's very, very current, this particular subject. So hopefully you guys will enjoy it, and I'll see you all then. Thanks very much.